To what extent does the FOMC feel pressure to keep interest rates low because of the financing of the federal deficit with short-term T-bills? And how does that consideration fit within the Fed's dual mandate to keep prices stable and keep unemployment low?
Yeah, that's an easy question to answer. That really never comes up. I mean, that's not something we think about at all. We're thinking about keeping interest rates low as a way of, as I described, it stimulates more spending by consumers because, you know, if your choice of a consumer, you can put your money in a bank account or you can spend it. Keep interest rates low, people are more likely to spend that money on the margin, and firms are more likely to undertake investment projects. That is going to be a way to stimulate employment, and so that's the sense in which the way we think about it. So that pressure it doesn't come up at all.
Okay, great. Next question: should the Fed continue to have full employment as a goal, along with controlling inflation?
So this is a question that's come up recently because there's I believe a proposed legislation to change what I've described a dual mandate for the Federal Reserve, which is to have promote maximum employment and promote price stability. And there's a proposed legislation to remove the maximum employment part of that statutory objectives and just focus on promoting price stability. So let me say a couple of things about this. First of all, this is the purview of Congress. It's up to them to make this decision, and they can, you know, whatever they tell us to do, we'll do. You know, that's the way the structure works. And I think it's an unusual time for this conversation to come up, in the sense that if you look at the committee forecasts, so the FOMC, I've described how the FOMC participants will submit their assessments of where they think inflation is going to be. Maybe I didn't describe this, but they do. This is part of the forecasts that are released on a quarterly basis. And you'll see their forecasts are, they think inflation is going to be below 2%, and unemployment is going to be high by historical standards, to put it one way. So there's the point of that is there's no tension right now between those two mandates. The way to deal with both of these problems, inflation being low relative to 2% and unemployment being high relative to historical standards, is the same, which is to have monetary accommodation in place, to follow a highly accommodative policy. So it's an unusual time, I think, to have the conversation that we're having about going down to two mandates. I also think it's true that even central banks around the world, and many do, only have one mandate. I think they're always looking over their shoulder, nonetheless, at the broader economy, the real conditions. In some sense, I think of the U.S. system as, and I'm proud of this, is an honest one, an open one, in the sense that even if it was not explicitly a mandate of the Federal Reserve, and we would be focusing on price stability, I think there would be an interest in, if unemployment is as high as it is today, in what monetary policy could do on that dimension. So I think there's a certain degree of openness about having both mandates in there. But as I said, this is up to Congress. This is Congress's purview. We'll do whatever they tell us to do.
Great. Next question. Please comment on banking conditions and your views on credit availability.
Well, I think banking conditions are improving. I focus mainly in the 9th District, but can look at it in a couple different ways, and more nationally as well. But in terms of the 9th District, we have our head of supervision, Ron Feldman, Senior Vice President in charge of supervision, does a press briefing every quarter. That's available on our website. And if you look at that, what you'll see in the 9th District is we're seeing improvement in banking conditions around the 9th District. In terms of credit availability, this was I would say 2 years ago, I'll start with a statistic and talk about that. Loan growth has remained very low, both in the 9th District and nationally. I think for a long time, there was a question about whether that's due to lack of availability of credit or is it due to lack of demand for credit. And I have to say, speaking for myself, I've become more convinced over time that the issue is really that lack of demand for credit. And one way to see this is that usage of lines of credit, available lines of credit that have already been granted, remains very low. And so I think one of the challenges for us is that for whatever reason, businesses do not feel the level of confidence necessary to go out and use credit that is even available. So the good news is we are seeing improvement slower than we would like, but that's always part of the game. At the national level, I think the recent stress test in connection with the capital planning exercise that was done by the Federal Reserve for the 19 of the largest financial institutions in the country released what the Fed did was to look at what kind of levels of capital these large, important financial institutions would have in case of a very adverse shock, unemployment going, one that I immediately will say we view as being just a way of testing what's the ability of the banks to survive. It's just an incredibly adverse scenario, and in that adverse scenario, I think you would say that the vast majority of these banks came through very well, and so I think that we should have confidence just from that as well.
Thank you. Do you foresee a need for further rounds of quantitative easing?
So this is an interesting question. And now, I'll be speaking for myself and not for others on the committee. And I've said that before, but this is especially true now. I think that what we've seen over the past year or so is an increase in inflation rates, and we've seen a decrease in unemployment. Not just, and it's important not just to be thinking about what's happening to inflation itself, but also our outlook for inflation, what we think inflation is going to be doing in the future. That's also risen, and our outlook for unemployment has been coming down. So I would say that points to having less a need. The right policy response to that would be have less accommodation in place than we did, say, a year ago. And in fact, the committee's moved in the opposite direction. It's moved towards having more. So under my benchmark scenario, I do not see it. I would say I don't see a need for additional accommodation. In past speeches, I've talked about the fact that I think what we should be doing is thinking about remaining highly accommodative, and we have an extraordinary amount of accommodation in place right now. We're keeping the committee statement says I just mentioned that the rates are going to be the committee anticipates rates being extraordinarily low through late 2014. The committee has purchased a large amount of longer-term government securities in an attempt to put and government-backed securities in an attempt to put downward pressure on longer-term interest rates. I think we should be because I think it's an appropriate time to start to think about when to begin the process of reversing the level of accommodation. So under my benchmark outlook, that would be what I would be thinking about. Not today, but I would say in 6 to 9 months down the road, we should be thinking about initiating our exit strategy. But there are scenarios. With that said, and this is what I mean about public contingency planning, there are scenarios, there are shocks to the economy that would take place that would lead me to contemplate the need to become more accommodative. And one way to become more accommodative for us, given where we are in terms of interest rates, is to do more quantitative easing, which means more purchasing of longer-term government and government-backed securities. And I think it's natural for us to be thinking, if that were to become necessary, if inflation were falling and/or unemployment were rising, I think in either case, by a sufficiently notable way, I think it would be very natural for us to be thinking about buying additional mortgage-backed securities. These are mortgage-backed securities that are issued by Fannie Mae and Freddie Mac. They're government-sponsored enterprises. We're allowed to do that by the Federal Reserve Act. This would be an attempt. The reason you're doing that, you're buying longer-term securities, taking them out of the marketplace, private markets. That means that the private market is less exposed to interest rate risk. that means that if we put downward pressure on long-term interest rates, that makes corporations more willing to undertake longer-term investments. And that would be, I think, the right response to an appropriate scenario. So I feel, I'm often asked, what do you think we should be doing? And there's so much uncertainty about any given outlook. Any forecast anybody stands up and makes has a lot of uncertainties built into it. And I think we should be talking more about not just what we're going to be doing in the benchmark scenario, but how we would be addressing if things happen that we didn't anticipate, as has happened in the past.
Absolutely. And some of these may be covering a little bit of the same ground. There may be some subtleties to your answer, so I'll go ahead and read through them. Does it make sense for the Fed to be given two goals? A, maintaining the value of the currency, and B, maintaining high employment and the economy. Can the Fed really do both, or does reality force a choice of one or the other?
So the framework statement, so in terms of, I'm going to take the terms value of currency and talk about that in terms of promoting price stability. I assume that's what was meant, but I don't know for sure. So, you know, the framework statement does talk about that there are times in which there will be a tension between the two objectives. And at that time, the committee will have to weigh those objectives against one another. I guess that I would stress that if you look at the consensus viewpoints of the committee right now is not such a time. You know, that's, I think, the takeaway. But this framework statement does talk about, and it's in high-level language. You know, it's that there will be an attempt to weigh the objectives against each other, and the basic point is, you know, it's going to depend on how high one is versus the other, and that kind of thing. So it will depend on circumstances. The point is, from the point of view of the consensus viewpoint of the committee right now, there is not a tension between the two objectives.
Well, that's definitely an answer everyone in here can understand. It depends on the circumstances, right? It's how we live our lives. And the last question, unless there's something from the floor, does the FOMC ever consider or discuss the political implications of their decisions? What action would the FOMC like to see from Congress or the White House as relates to monetary policy?
Yeah, I mean, you know, we're about economics. You know, I've described us as being wonks. I'm sure all my colleagues are pleased by that, but I'll stick to that. We're basic tech. You know, we're doing a technocratic exercise of trying to adjust the course of monetary policy to fulfill the objectives that have been given us by Congress. I think I think it's obvious to all Americans right now that over the longer term, that we face some fiscal challenges. I think that we have enough set of obligations that we've made as a country to our older citizens in particular. And the current course of tax accumulations are not going to be sufficient to keep up with those obligations, and you know, something has to give along those dimensions. I think the leadership of the chairman of the committee, Ben Bernanke, has talked about this, and I feel comfortable saying that it would be good for the economy to have more clarity about how that tension is going to be resolved. Even though it's not a tension that has to be resolved in terms of policy directly in 2013 or anything like that. It's more that how this is a problem, an issue that's going to be realized over the next 10 or 20 years. But how are we going to start to deal with that, and what are the contours of how that tension is going to be resolved? Obviously, you know, this is a subject of great debate right now, but to the extent that there is more clarity offered, the better it would be for the economy. I'm certainly happy to take other questions from the floor if there are. Yeah, I'll start. You
At the same time, the committee projects a 2% inflation rate into 2014. In essence, you echo back to Congress saying, I'm taking inflation out of your quiver, and you better deal with this either through taxation or less spending. Well, I think we know which way they're going to go, so you're baking in an expectation of higher taxes, taking a change in inflation off the table as a tool to deal with the debt, which I think we'd all agree we need to deal with something. So I was just wondering, the prior question about whether or not the political realities are reflected or thought about. In essence, when you're saying we got to bake in some expectations of low inflation, you are taking inflation off the table as a tool to deal with the debt.
Yeah, and we view that as being, so just a question of what price stability means. And so, you know, the committee released a statement with a quantitative definition of price stability. But it's, you know, if let me try to just articulate what I have in my mind here. That's what we view as our goal, and that's what we're supposed to do. And so that's it. I mean, and then what Congress has to do to resolve their problems is, and the president, and the voters really at the end of the day, that's up to them. But yeah, I think that COLA price stability is good in a lot of dimensions in terms of confidence in U.S. debt, confidence in U.S. currency. All these things I think flow from that kind of commitment.
Could you explain what's magic about 2% and what are the dangers of falling below 2% for the economy?
Well, this is a great question. I think that there's a couple of reasons why 2% gets picked. One is issues about quality adjustment in price indices. There's a sort of technical issue that there's a general sense of that the challenges in quality adjustment typically mean that that 2% is more reflective. A measured inflation rate of 2% is actually closer to being something that would be actually lower than that, just because of the biases that are in the index. But that's a technical thing, and I think the more important issue is really about the situation we find ourselves in right today. That the lower you keep the inflation rate, the more likely you are to run into the zero lower bound. Because if you keep the lower you keep long-run inflation rates, the lower long-term interest rates are going to be. And that means that the more likely you are to run, as you're trying to do the kinds of things that the Fed has been doing over the last few years, which is to provide accommodation to be supportive of the economy, you're going to run into this issue of the zero lower bound. So 2% is a way to weigh off this versus technical consideration I described, but I think the more important issue of the zero lower bound against the cost of having higher inflation.
We all know about the mortgage crisis and the bailouts and so forth. And I think there's been an overreaction. Clearly, we don't want to have a situation where we loan money for a mortgage based on the buyer having a pulse or not. But I think it's been an overreaction to requiring pretty high, credit score and a high debt to equity ratio and so on and so forth. If it were eased and we allowed more people to get mortgages, it seems to me that would create a demand and turn a lot of toxic assets from red to black. And is there anything the Fed can do to encourage banks to start loaning again, or is that more of a Congress?
Yeah, I think a number of the issues you touched on, I don't see as being in our purview. I mean, it's really, and a lot of it's just private sector. Frankly, you're pointing to responses on the part of the private sector to the conditions, and that's certainly up to them to be making those judgments. I think what the Fed can do is to, by keeping interest rates low, can certainly make home purchases for those who qualify more attractive. It can put more money in people's pockets through the refinancing mechanism. So those are the things. That's the channel through which monetary policy operates, is by and that's certainly the Fed is, I think, stepped up to the plate on that dimension. Yeah.
If, for some very strange reason, Congress were to go after Ron Paul and pass a gold standard, limiting the amount of money that's available for Fed funds borrowing, how does that affect, putting a limit on the cash supply, how does that affect everything that you're doing on monetary policy?
Well, I think that the point of the gold standard is to tie, and there's obviously subtle nuances about who means what, but the traditional understanding of it was to try to peg the value of the dollar to the price of gold, that's going to removes a lot of the flexibility involved in the making of monetary policy. I think that So Chairman Bernanke gave a series of lectures at George Washington University at the end of March, which I'm sure are available certainly on the Board of Governors website, probably on ours as well. And he talked at great length about the gold standard and the problems with it. It's basically I think one of the ways to see it is right now that in times of great uncertainty, gold gets driven up in price because people run to it as a safe haven. This has been true historically for many years. And it's not just inflation concerns, because if you look at the gap between TIPS, Treasury inflation protected securities, and standard treasuries, those don't reflect huge amounts of inflation concerns. It's just concerns about safety. That drives up the price of gold relative to all other goods in the economy. So we would be facing, if we had been on a gold standard, we'd be facing a significant rate of, and stuck to it, which is a big question mark. What happened in the Great Depression is we were on a gold standard, had significant rates of deflation, we abandoned the gold standard. And so I think the problem with it is it locks you into a degree of rigidity that you don't want exactly in the kind of episodes we just went through. Because the kind of deflation that we had in the Depression was hugely damaging, I think, to the economy. 10%, double-digit rates of deflation fall in the price. Wow, I managed to exhaust the lawyers. Oh, okay.
Just, I'd like your thoughts on labor force participation. It's been dropping, and it is down at what, 40 years old or something like that.
Excuse me, I couldn't catch what you
I'd say it's down at some long-term low level of, haven't been seen in the last 40 years or so.
So yeah, labor force participation rates have fallen back to where they were about 30 years ago. So what I think this is an ongoing issue, so labor force participation rates have fallen, and I think that the big question mark for policymakers is to what extent is that going to be reversible? That is, as if the economy improves, will those people start to come back into the workforce, or is this something more persistent, more permanent? And as with most things in economics, it's probably a mix of both, and trying to sort that out. I guess, speaking for myself alone, I do see these changes as probably more persistent than some others might. And that shapes my view in terms of what maximum employment is going to mean. And that shapes my view about what appropriate monetary policy is as a result. But I will be the first to say that it is very challenging to sort out what's going to happen with this. Will these changes reverse themselves if we had a sufficiently strong economy? I think it's very hard to really answer that. One color I'll add to that is that people often talk about demographics in regards to the statistic that it's being driven by older workers choosing to stop out earlier than they might have otherwise, or younger workers staying out of the economy. One thing that's interesting is that you see a pretty marked fall in labor force participation, even among workers in the United States who are aged 25 to 54, usually the people we think of as being prime age. There's been a decline, which is accelerated, in male labor force participation, going back many, many years. Female labor force participation, as we all know, as women came into the workforce, rose up until about the year 2000. Then it stabilized, and then it has fallen so it's now what we're seeing is sort of both male and female labor force participation rates over the last few years have fallen, and that's contributing to a decline in the overall one. But I think the one key point is it's not purely demographics. It is also these prime age workers between ages 25 and 54 are leaving the labor force. Yeah.
I was just going to ask you got the opposite problem in your district up in northwest North Dakota. You got people that they quote quit looking for a job, but they won't move up there. It's kind of a fun study, I would think. And how long do you think that will be? Assuming oil will stay above, if it's $50-60 a barrel, they're going to continue to dig up there. So, have you been studying that? And I'm just curious, is that a 10-year outlook? Are you seeing some China issues where we all know they're kind of building man camps, really cheap housing? I'm curious about infrastructure thinking.
I went up there to visit last when was it now? I guess last fall, I went up to visit Sidney, Montana, which is on the western edge of what's happening. So, and I think that I am not going to be. It's hard enough for me to forecast what's going on in the heart of the economy, let alone forecasting what's going to happen to oil prices. But right now, it's a source of enormous energy, economic energy. It's unlike anything. I really think it's unlike anything that's happening anywhere else in the United States, and there's tremendous demand for workers there. Unemployment is low throughout North Dakota, but the talk you hear when you talk to people from this part of the world is all about labor shortages, and it's now how long will this last? That's something that it's really up to the private sector to make those judgments on an ongoing basis. The one thing I would say is that some of the problems that are faced, there's a certain circularity, some of the problems that are faced. If people had more confidence in this being persistent, then there would be more infrastructure built and they would have an easier time attracting workers. So there is some circularity in terms of how long how confident people feel about this. But we're studying this on an ongoing basis. We're going to be going up. We have a board of directors of the Minneapolis Fed. We'll be having a board of directors meeting in that part of the world in Minot, North Dakota, later this year in August. And so we continue to study it. We're interested in some of the questions about how can we have such a pronounced labor shortage in such an integrated labor market as the United States. And I think it points to some of the frictions involved in maybe not everyone wants to move to North Dakota. And so that those challenges in moving and mobility, I think this is a very stark example of how those can manifest themselves, even in as well integrated an economy as we have in the United States. Obviously, no formal frictions, no formal boundaries, but divide the states. Okay, now I'm exhausted.
Very good.
Thank you very much. I appreciate it.